Hello everyone. In this video, we'll break down a method called mean variance optimization and show you how you can apply it using Python. So MVO is a very efficient and simple way to optimize your portfolio given a certain degree of risk. So whether you are a CFA candidate, an investor, a quant, a data scientist, this is a fundamental tool worth mastering, especially for asset management. So MVO was introduced by Harry Markowitz in 1952 and is right now considered one of the most important tools in modern portfolio theory. So the goal is quite simple. We want to help investors to find the most efficient portfolio. So one that offers the maximum expected return for a given level of risk or the minimum risk for a desired level of return. So for this model, we want to maximize the investor's utility. So it's the expected return minus a certain degree of risk tolerance. So for example, if an investor is less risk tolerant, he will not choose risky assets, so they're gonna have a lower expected return in comparison with an investor that is more risk tolerant. To run this model, then we're gonna need some variables like expected return, volatility, correlation, covariance. So we're gonna use those variables to optimize optimization problem. So we're gonna produce portfolios in one efficient frontier, and then we're gonna have the tendency portfolio, which offer the highest Sharpe ratio, and we are working in strategic setting. Um, so we will use annual capital market assumptions and getting the data over a 10-year horizon. For example, if you are more into a tactic or short-term strategy, you can reduce these to 3, 4 years, 2 years. Or in strategic, you can also choose 20, 15 years. It's up to you and your assumptions. And we want to maximize this function here, which is the Sharpe ratio, which is the weights of each asset class times their risk premium divided by their standard deviations. Subject to these restrictions, like all the weights, the sum of all weights should equal to 1 and must be between 0 and 1, all the weights. So yeah, in this article, the focus is to discuss the structure and logic of mean variance optimization. So I won't take a lot of time explaining how I took my assumptions to forecast the returns and volatility of certain asset classes, since I base myself into another investor's expectations. So for those inputs, you can use your own macroeconomics and statistics expectations to make your own assumptions. So the first step to do it is selecting your investment universe. In this case, I'm choosing asset classes, not individual securities. And I see most of people use selection of stocks and want to find the optimal allocation between those stocks in their own portfolio. But I'm basing myself into the CFA level 3 material, so I'm trying to make it the most similar as possible in terms of the theory behind it. So I've chosen asset classes, and in my opinion, this can be the hardest part of all this optimization method because it's kind of relative and also depends on the investor IPS, so the goals, objectives, constraints. For example, some investors don't want to invest in emerging markets, so this could just be cut off from the list. Um, and also selecting the ETFs is also hard because one asset class can have a lot of ETFs with different compositions, different assumptions. So it's also kind of hard to choose it. Also, asset classes shouldn't overlap. For example, securities is here in US equities shouldn't be in non-US developed equities. Um, there are also a lot of more secret asset classes I could have chosen, like for example heights, or I could split US equities between large cap or small cap. So it depends. It depends a lot in which what are considerations. Uh, but the more asset classes you use, the higher the potential diversification you can have. So to run the model after choosing the asset classes, we're gonna start with the data collection. So those were all the variables, or sorry, all the libraries I used here in Python to model all this. So I used the Wave Finance to get all those stickers, which were the asset classes I've chosen. Um, the end date is today, in this case 13th of May, and I want to start uh, 10 years from this date, so I choose this number here 10. If you want like 5 years, just put 5. If you want 15, just put. So this is how I, an easy method to have your time horizon. And then I I've I've put all those asset prices into a data frame, and in this data frame I use the auto adjust equal true, which means that the close prices will be adjusted, so you don't have to put the age of price because it won't work. If you want more raw data without adjustment, you can put false. But with true, the close results are already adjusted. So to see how it's going, I'm gonna write here the data frame, and yeah, it's working as it's supposed to be since 2015. All the asset prices and the last asset prices of each ticker. So after retrieving the data, now we're gonna calculate the log returns. So I use this NumPy log, and then dropping all the NAs. I'm gonna put on this series the log returns, the mean, so which is the annualized log return of each ticker. And then on a data frame, I'm gonna put all those covariances and the volatilities. I'm gonna use a list to have all those volatilities. So we can start printing what were the each ticker return and volatility. And we can see that US equities had a very high Sharpe ratio, a very high return, and for the volatility. So Sharpe ratio higher than 0.5, whether other asset classes just underperform. Like look at emerging market government bonds, like they perform poorly and they had a high volatility. Corporate bonds were slightly better, but still performed quite bad. And gold had a very high Sharpe ratio during this 10-year time horizon. So uh, the past decade was characterized by exceptional strong performance from U.S. equities, particularly large cap stocks. So if I did like a split between large cap and small cap, uh, we're gonna have this more composed between both types of equities. And bonds and emerging markets underperform and exhibit a high volatility. So we can see even before running the optimization, the returns and the volatilities in asset classes were very large, and yeah, it's highly likable that it's going to be concentrated between U.S. equities and gold in this case. Um, so we're gonna plot to see exactly what happened, and it's possible to see that U.S. equity just like overperformed every asset class, mainly after COVID. Uh, the stocks prices just skyrocketed, and then also we had like a very high bull market in 2024. Like even before COVID, it was already overperforming other asset classes. If I took this 10-year photography, like it can be high different in 20 in 30 years if I take a large amount of data. The same with gold. It presented a very high return, specifically in those last years. So let's understand. Uh, we had all the returns and volatilities, but it's very important to know the correlation between each ticker. So let's plot this. Yeah, we can see, as expected, government bonds are just negatively related with stocks, with U.S. stocks. Gold had has also a very low correlation with other asset classes, which will contribute to have a lower covariance in the end. Um, let's put a heat map. It's easier to visualize. Like, yeah, we can see government bonds negative correlation. Gold also very low. We can see that uh, emerging market corporate is also very low, and we can see that with this correlation matrix, then we're gonna multiply by each standard deviation, then we're gonna plot the covariance matrix. So as we did here with the S, we can also do it since since the correlation matrix and the covariance are both data frames. I can just put it here, for example, this is the covariance. Oops. And yes, the gold, yeah, just had a very low covariance, and this is going to contribute a lot for selecting this asset class. Then we define the risk-free rate. I'm basing myself into the CFA material, which was 2.5%. It's not very realistic. So a better way to do that is using the Fred API to get the 10 years yield returns from US. It's kind of easy. You can get this API key in 3 minutes and get the latest release is just 10 in my case because I want to select the 10 years. And as a result, I got 4.28%, which is quite high, almost double of the risk-free rate. So the sharp rate is gonna just melt with this model. Um, you can consider it, or you can use just a normal risk-free rate, like because if you take a very long time horizon, you, you can just see that most of the time the risk rate has always been low. So it depends on your assumptions about it. But in case you want to get real data, you can just choose this, or you can go in the internet and see how are the yields and just input here. And now we're gonna run the optimization. I've chosen to run the Pi portfolio opt library. In my opinion, this is the easiest way to do it. You can also run other libraries like some linear algebra libraries, and some libraries specifically that maximize or minimize a function, so you can make it more personalized or do your own mathematical models with it. But yeah, to start, I think this is a good library to start. The inputs are quite easy because, like here, the efficient frontier function, you just need the return and the average return and the covariance. And with that, we're going to have our weights in this function, the weights that maximize Sharpe ratio given a risk-free rate. And then we're going to get our clean weights, our return vol Sharpe, risk premium. And let's see. Now we're going to want our portfolio return, our risk premium, which subtract by the risk-free rate, and our volatility and our Sharpe rate. And as a result, as expected, most of our allocation were in US stocks and gold. and we get a 10.19% return, 7.69% risk premium, 11% volatility, and quite high Sharpe ratio. But guys, come on, this is not realistic. This is really not realistic. Like, this is not gonna happen again. We are just using this as an input. You can consider this to in a model or something, but this is not realistic. Basing on all this historical data and base yourself that everything that happened 10 years ago will happen exactly again. No, but in the end, this was the optimal weights. Uh, Gold was had a lot of favorable variables. Firstly, it presented like a very high Sharpe ratio, and it also is very less correlated to other asset classes, so the covariance will be very low. So yeah, it's very favorable for gold and U.S. equities since it also had a high Sharpe ratio, and also it's not very correlated with gold. So in combination, this is kind of the tangency portfolio for this investor. One curiosity, in the CFE material, they also consider cash as an asset class, um, but you can also consider cash as a kind of the risk-free rate when you choosing the percentage you want to allocate in risk-free and the percentage you want to allocate into the tangency portfolio. So a less risk tolerant investor will have a less percentage allocated to this agency portfolio. So we're gonna keep going. Uh, Going back here to the article, we're gonna go to the next step, and we're gonna get the inputs of the expected return and volatility. And while historical return can serve as one parameter for these projections, they also help to identify the key variables influencing market behavior. And yeah, we're gonna have something called capital market expectations, which is an investor or a firm has their expectations of what's going to happen with the economy, what's going to happen, for example, with the yield curve, according to the economic cycle, and based on that, they're gonna predict what's gonna happen in the next 10 years with the returns and the standard deviation of each asset class. So I've collected some data on what are the expectations for all those asset classes I've chosen. So, for example, U.S. equity, I select some sources like BlackRock, State Street, Voya. They expect 6% of annual return and 16.2% in standard deviations. But non-U.S. equities is expected to have a higher Sharpe ratio. Maybe they're expecting that U.S. equities are overvalued right now. They have a high multiple, and for example, European stocks didn't perform as well, and maybe they're expecting that they're gonna start to get higher returns. Emerging markets, corporate bonds also very nice Sharpe ratio. The market is expecting high yields for them, and it's kind of nice to see. And I collected in a lot of sources. Emerging market corporate bonds have a better Sharpe ratio than government bonds. Like they have a higher expected return and a lower volatility, maybe because of the empirical duration, since sometimes the spread goes in a negative direction from the benchmark. So maybe this is one of the factors. But anyway, an investor, you guys looking at the video, you should have your own expectations and standard deviations for each asset class. Uh, another another factor I'm considering, I'm taking the same historical correlation, which might be not ideal, You can plot your own correlation matrix, the future correlation matrix. Maybe you're expecting a recession, and in a recession, maybe U.S. equities and U.S. Treasuries gonna increase the correlation. So depending on the economic cycle, certain asset classes get more correlated with each other. So this might be one of the considerations you might have. So you don't need to base yourself into past correlations. But for this model, as a way to make it more simple, I just use the same correlation matrix as before. But the covariance is going to be different because the standard deviation changed. So let's see how it's going to be on Python. So yeah, I created a panda series. And why a series and not a data frame? Because of the how the efficient frontier model library works. So yeah, in the end, I needed to create a series. So I put all these expectations of returns and return expectations and standard deviation expectations into those series. Uh, and now it's kind of the complicated part that I have to cure a bit the data because in the first example, uh, the when I calculated all the volatilities and the covariance, they already came in the right way. I already had the covariance matrix automatically. Here I had to do some steps, like I need to create the shape of the covariance matrix. Like for example, here I did a print in the other vols. So I needed to make all them in this format to create to multiply all those numbers by the correlation matrix. So I did this and I created this other variable called as forward. As you notice, I just put like all the same variables we had. I just put underline forward to differentiate both values. So I put here as forward, but you can also just put as if you want, to remove the past data. But yeah, I just put forward. So I multiplied these variables by the correlation matrix, and as a result, I got the new covariance matrix. And then I converted again into a data frame, so I can have the covariance matrix into a data frame and run in the model as before. So in resume, that's all what I did. As you can see, the correlation matrix is the same as before, but the covariance matrix is very different because the standard deviation changed. And again, guys, you can just make your own prediction of how it's going to be. You don't need to use the same. You can just change all those numbers. So yeah, here I did exactly the same thing for the optimization model. I just changed those those variables, the mu forward and s forward as here. The mu forward I didn't have to change anything. It already came in the series as a PD series as before. And yeah, as a result, I basically just copy and paste from the other from the other model. And yeah, as a result, we have a very different and more diverse as allocation. And Chacha, no U.S. equities. Yeah, it's not intuitive. Like, why not U.S. equities? And again, this is a mathematical model. You just put your assumptions, and the algorithm gives to you. Uh, you can also choose to have uh, a minimal threshold for U.S. equities, or a minimal threshold for specific asset classes, or a maximum threshold. It's up to your assumptions if you want to use it. In my case, I didn't use this assumption, And why no U.S. equities? Because boom, non-U.S. developed equity just ate all this. Uh, so yeah, since the market is expecting this to have a higher Sharpe ratio than this, and non-U.S. developed equities have a kind of uh, also not so high correlation with other asset classes, they just over allocated to it. But again, you can just choose another asset classes or different assumptions. For example, I can just go here. Let's see. Oh, I'm very optimistic of U.S. markets. All those people keep saying bullshit, and I don't believe that. You can just change my assumptions and let's see. Janja, it just a lot of other allocation just left. So you can just keep playing with your assumptions and see which one is more viable for you. So this is a resume of what's happening here with all we got from the MVO. Uh, so it there's like a justification of why this might be happening. But MVO also has a lot of considerations. Like as you notice, we had a kind of high allocation to bonds, but we should be very careful with taxes because in comparison with capital gains and dividends, those bonds are heavy taxed, are more taxed. So if we take it into consideration, do another model considering taxes, there will be probably a far less allocation um, to bonds. So also we didn't consider alternative assets, just gold. But you could also get like a hedge fund or a private equity index and put into the model. There are also private real estate and other liquid assets, but you would need to unsmooth the returns and do a series of statistical methods to remove the serial correlation. I didn't use any constraint, but most of cases you use constraint like minimal allocation, maximum allocation. So I didn't use every possible asset allocation. And the MVO also has limitations on its own, like they're very sensitive to small changes in the inputs. They tend to be highly concentrated, and many investors and analysts are concerned about other variables like VAR, skewness, maximum drawdown. Just like in the skewness level, not much into the volatility in the standard deviation level. Doesn't take around, I thought about taxes, but also fees, trading costs. There are some asset classes that are more expensive to trade. And also we have pension funds that need to use other type of models completely different from MVOs because they don't want to max. The objective is not to maximize the Sharpe ratio. Their objective is to uh, have a more liability or asset driven strategy like a duration matching, or like they want to maximize their surplus um, given if they have a surplus they want to maximize it, and all the rest they want to equalize the liabilities. We also have other models that when MVO is not suitable, um, I think the most common is to do a reverse optimization, which is kind of opposite of the MVO because the allocation weights are already assumed. We use like a CAPMA to as a way to get those inputs, and with that we get the returns. The Black Litmer model we use the reverse optimization, but with their own analytical assumptions of it. So we build it from the reverse optimization, and we incorporate those investor specific views. We can also have resemble mean variance optimization. So we can integrate Markowitz mean variance with Monte Carlo simulation. So it's a very good way for account for uncertainty because we have a lot of uncertainty here. Like uh, the asset, those asset classes might not behave as we are expecting. Specifically, we expected a 10-year return. Like, so doing some simulations, Monte Carlo simulations with those asset classes might be a way to uh, alleviate the symptom of this disease, which is called uncertainty. As an example, we have here in this BlackRock report, they have a series of capital market expectations, like expected return, volatility of each asset class, and as a result, they have those strategic views of each asset class and the strategic asset allocation to each type of investor, like U.S. corporate pension. We have a very high allocation to bonds liability hedging, which what's a, this is what I was saying. Like they have different strategies. They allocate different as allocations to the surplus, and they sometimes want to do like a duration matching. So they usually tend to be heavily allocated to bonds for do this liability hedging. Family offices, more diverse, and that's something worth noting for institutional investors. Like they have been allocating a lot to alternative investments, mainly liquid assets, especially if they have a long time horizon. So depending on the investor's objectives, constraints, you have a very different asset allocation. So it's nice to compare. So this is it. I hope you all enjoyed the video and understood how the mechanism works.